We saw these fractional losses yesterday, and all it took was a tweet and a statement and everything else, and all of a sudden things just changed. Is this a market that investors need to worry about, or is it all noise?
No, I mean, there's a ton of noise, but to put it in perspective, I mean, we're still in the upper middle part of the range that we've established since August. The greater fundamental picture is that there are plenty of things to worry about. There's China, there's Hong Kong, there's Argentina. But on the good side of the ledger, there's a Fed that's very accommodative. And it seems like the market, every time something bad hits the tape, the market in their mind does the math of the Fed is going to adjust to it. And that to me, seems appropriate. It seems that the Fed has shown us that they want to get ahead of everything. I'm not sure it's the right policy for them to be as dovish as they are, but they are. The thing that amazes me the most is we've not become numb one bit to these Twitter bombs that happen. I want to get to a point where, because they get reversed often the next day. You know, last Monday we were down in the dumps. You know, something comes out on Twitter and we rally. The same thing happens again this week. Are the algos just reading the headlines and jumping in, and at some point in time, are they going to go, wow, this isn't exactly great business considering we reverse it the next day? I'm not sure.
So I mean, but Jim, to be fair, the markets have become slightly more numb over the course of the past 3 or 4 years to some of these headline risks. I mean, we are not seeing these 3 to 4% swings in stocks anymore. When we have a big trade announcement coming up on tariffs, it leads to a 1.5% rise or fall or anything else in the markets here. So maybe there is a little bit of sensitivity coming out of the marketplace. Isn't that what you think?
Yes, no, and I believe you're right. But it seems like over the last couple of years, what we've seen is that the initial tweet, it could easily be fully reversed the next day. So I'm not even sure that 1.5% move is justified, although I guess it doesn't matter. I mean, what it is right now, and right now we move, 1.5% on these things. Yeah, to your point, it's changed a little bit. We are getting numb, and I guess that's a pretty good sign.
Some people say that the 2 to 10-year spread on treasuries is not as important as we make it out to be, that it's not as reliable a recession indicator as it has been in the past. What do traders, what do you and your colleagues in Chicago think about that particular statement?
I am certainly one of those people. I think the long end has been distorted greatly over the last 10 years. Now, I've said this a bunch of times, and people take it to mean that I don't care about it at all, and that's not true. I think it's something that needs to be looked at, and it probably has some predictive power, but it doesn't have the predictive power that it did in the past. Plus, even when it did have, it was as powerful as it was before, the recession didn't happen for 14 to 18 months till after it inverted. So to me, it seems like that's, I'm a trader. We're talking about the now. Many times the stock market correction doesn't come for many, many months either. So I don't think the right time to panic is today.
All right, well, let's talk about the trading side of things, because what we have seen so far this year is a real convergence and correlation. In fact, the returns are almost identical for an ETF tracking long-term government bonds here in the United States and an ETF tracking gold prices as well. You throw Bitcoin in that mix into that whole rigmarole, and all of a sudden you have a situation where maybe stocks aren't the most attractive thing out there. Take us through how traders are viewing these various asset classes and where the opportunities actually are given this environment right now.
This is an excellent question, because you had someone on before talking about Bitcoin and how perhaps it's joined and is now sitting at the safe haven asset table. And I think that it is. But remember, there's two characteristics that are important. One is a non-correlation to risk assets, and Bitcoin certainly has that. I'm not sure it's inversely correlated like the 10-year is and the U.S. dollar is, and in time of panic, money will automatically go from stocks to the 10-year, but they are definitely, seems like, going to Bitcoin for diversification, and that's definitely like the first box to be checked of a safe haven asset. I think that gold, silver, and Bitcoin, the story on them since last November has been amazing. Right when the Fed started to begin its pivot towards more dovish, those things started to become more relevant. I think it's a really interesting thing that's happened, particularly the Bitcoin part of it.